Last week we got the end of the month, so we got some monthly charts here, and I think it'd be a good time to look from 34,000 feet up on what is actually going on here, because when you hit environments like this, and this is really important to get, you have to view things, in my opinion, when I look at this, you have to view it like a barbell. So you have one side where you have the very short-term trading, where you have your intraday, where we're having these massive moves, and we're going to get to that in a little bit and how you can monitor that and profit from it. The other side of that is long-term, meaning what exactly is happening long-term. The easiest way to do this is just going to be able to clone these, and if you clone them, you're going to get the same exact bar and then it'll match. Where people are struggling is in the middle. So when this starts to happen, you have the short-term side over here and you have the long-term side over here, meaning you're swing trading or you're following the trend or you're trend following. And then over here you have your day, and then in between this you have your noise, meaning you go home on Friday and then Monday morning there's tariffs. You come in by Monday morning and then there's no longer tariffs. And now you're dealing with the new things where what's going on with Japan this Friday? Do we need to be worried or not worried? How about into the weekend? Are there any new tariffs that are coming? Is there any more shifts that are coming? And we don't know. So we have the noise, which is creating a ton of gap issues, gap ups and gap downs. And then we have the long-term side of this and the short-term side of it. This is what we're dealing with. So what I found helpful in 20 years of doing this is you have to step back and go, okay, who am I? What exactly am I trying to do? Am I a long-term investor? Am I a short-term investor? And then you have to quantify those moves and say, this is who I am, I'm day trading for now, or this is who I am, I'm taking this long-term trend. And you can do both, you can hybrid, but what you need to do is identify what you're doing with all of these. So to start, where we're going to go with today, so you understand this, is we're going to start from 34,000 feet up and say, okay, we don't have to deal with all this noise now, but what the heck is going on? So we're just going to start with the basics here and just look at the ES. Now, if someone was to show you this chart and you were just looking at any chart whatsoever, you have your breakout bar and you've been consolidating, and then you have another bar of consolidation, and then of course you have February. There'd be nothing to concern yourself with here. If we start dropping down from 34,000 feet and put in some levels and go take a look at the weeklies, and what we'll do here to start is just get rid of the indicators for a second and just look at these key levels for a moment and realize that right here is our Fed level. Okay, this is the December 18th bar. And since that bar, we have not been able to close above it. We just haven't. For whatever reason, this bar, when Itchy spoke and said, I cut rates, I really don't have a reason for it, we were kind of on the fence, it was probably going to go down as history as the worst ever Fed conference ever, period, bar none. Cut rates, couldn't explain why you did it. It was so bad they actually had to do damage control on Bloomberg and CNBC the next day. You've gotten right to that top and you couldn't do anything about it. So down tests, that's where the 100-day was when it was right there. This is where the 100-day was when it tested here, and then up in here there was another 100-day test. But what you're seeing is you're up over wicks or price rejection here on the weekly, so you are holding in here. Now let's drill in a little further. Now, when we drill into this on the daily, here we are, all right, that's Itchy's bar, and you look at the low here and you realize you've only had a couple closes below that here, and then on top of that, how many closes have you had above? One, and you had no follow through. They gave you the new high, and then after the new high, they gave you a doji, and then that was it. The wick that tried to get you over, completely rejected, you've gotten an island, tries to get over again. Now, what this is telling us, and where I think you have to really be paying attention to this is, and this is a concern of mine, since Friday, on January 10th, you're red. And then if you go to the next Friday, and you're 16th, you can see that you're green. But you go up here to the next Friday, and you're red, as you broke out, and then you have a gap down. And then if you go through it Wednesday, Thursday, Friday, and then you close down, low of the day. Then you rally, and then you close, low of the day. So you should be able to see a pattern that has flipped here. That when we're going home on Fridays, they're selling. And I'm going to explain why Friday selling carries more weight than any other selling. We're going to get to that in a moment. But first, let's just continue the party and drill down and look at this on the hourly. And you can see it's not like it didn't have a good day. But what you're seeing here specifically on the 31st here on that Friday is just outright selling. And then you look here, what happens right around that time, you say, boom, just outright selling. It's not once that this is happening. It's a consistent bias at the end on a Friday of dumping stocks. And the problem with this, more than anything that people kind of have to take from these days, is why is that happening? Now, I'm going to explain this as simple as I can. and you're going to have to deal with my raw, unedited version of this, but it's really important to get this. Let's start with this little box. And what this box is this is going to be a pension fund, and they're going to have a lot of shares to sell. And let's just say that they have 1 million shares of Apple to sell, right? And we'll just type it in, to sell. All right, now what that's going to be is they're going to go to their broker, and let's say their broker is Morgan Stanley, and they're going to go, hey, we're going to give you 100,000 Monday to sell, 100,000 Tuesday to sell, Wednesday, Thursday, Friday, whatever, however they want to space it out. But when Friday comes, and then they're here, and then that's Monday, Tuesday, Wednesday, Thursday, and then here and Friday, and you're going to just have to bear with my crude light drawings because I'm not going to have time to do any better. So when you come to Friday, and it's Friday at 10 o'clock, right? And then you're here, and you still have 250K left to sell. It's got to go. You have to get out of it. So what happens, because you're a pension fund, you're not sitting there looking at this and going, oh, I'm just going to hold on to it. You made a decision, and based upon that, you want to get out. Now, whether that's based upon your assumptions, which we've gone into before, but why this is important is Fridays, this is what happens. They just start dumping. They're like, whatever, man, just get me out. I'm supposed to be out of it. I'm not. So it's not even the last hour that's so important. It's those Fridays that you have to watch. And we're starting to see more and more of that. As a matter of fact, there's actually an indicator that we're going to go over here called the last hour, which measures the last hour of what's going on. And it's absolutely fascinating because it's really that simple. They try to spread it out and they try to get their price. This is why everybody looks at VWAP, because that's where the institutions are at. Institutions get paid, hopefully you get this example, and I'll just bring it home this way for a second. So if you take something like an Apple, for example, what they're doing is this. They're going out there and they're going to JP Morgan, who wants their business, and going, sell $250,000 today and get me better than VWAP. So now that guy's going, oh crap, VWAP's plummeting, and I'm supposed to get them better than that on $250,000. I got to get out now. I'm going to get out right now. That's why these things move the way that they do. Or when they get to VWAP, you can see, hey, get me out. Well, why is that holding? Because someone probably said I have $1 million to sell after earnings, right? Get me out. That just happens to be last Friday, and it just happens to be the area that you can't get out of, right? That's why I always tell people to mark these pain points. Once you understand that, and you understand what's going on with that game, and it's not like it's just so we're clear, it's not like they're going to say, don't sell, we'll just do it on Monday. That's not how they work. They have charters, they have to follow them. So you can actually use their size against them. This is why I always say we're the remora, they're the sharks. We just follow what they're doing and we just pick up and eat. So when you see this, they're getting out of equities, and they've been getting out of equities no matter how we want to look at it. Now, if we spend a little more time looking at this and you just watch these days at the end, you can see it. Now, as we're looking at this, we're going to roll it all the way back and say, okay, but let's go take a look at the monthly and go, right, well, what about the monthly? And then when we go and take a look at this, we have to get rid of the draw links. Let's hide it all. And so when you look at this, you have to go, well, who am I? Am I an intraday trader? Am I swing trading, or am I a long-term trader? Because if I'm a long-term trader and I want to own the index and I want to own the right names, do I really need to do anything? And here's a great example. So if you take a look at Meta, from 34,000 feet, what are you doing here? From 23, have you really needed to do anything? I mean, you have a crystal clear breakout, rallies, forms an evening star, and rips. Take a look at the weekly. Do you really need to do anything? Is there anything that you need to do? A matter of fact, people looking at Meta, and hopefully you understand where we're going with this conversation. I appreciate your comments on this, because this video is going to be done obviously off the cuff. But I need you guys to kind of wrap your head around this, because I'm seeing so many people, not only in our community, but in public, like the emails that I'm getting, the frustration that I'm getting. And it usually comes down to how your identity is and where your identity and how it shifts. And I'll tell you what I mean by this. Like, are you a day trader? Are you a swing trader? Are you long-term trading? Are you just saying, I'm here to make money and the volatility is too much, so I change based upon that? Whatever it is, if you're not identifying what you're doing, then you're just throwing, I'll call it spaghetti against the wall and seeing what sticks. And you have to watch that. For example, if I look at something like Meta on the weekly, well, you just flipped an upper channel. Now, if you've been watching this video for the past 3 years, or even when we started Twitter, we started talking about these upper channels. Let's see where that fits, right there. What a coincidence. And you start flipping these things, they can go parabolic when you start popping out of these, just like it flipped here and then starts the new tier, right? So if you were just trading this and you're a long-term investor, you don't have a care in the world. If you're here and you're looking at this, you really don't have a care in the world. You've got a lot of nonsense here, and then you're hitting these days, Thursday, Fridays, where you're seeing some selling. But are institutions really getting out of this on Fridays? And then you would look at this and go, well, not really. No, Thursdays, Fridays, they actually are buying it. See, by understanding what we looked at with the index, you can then go and equate that and go and look at that on a sector and see what the sector is doing on a Friday and saying, well, yeah, we are seeing some selling here on a Friday. Yeah, some here as well. And then you can drill into the individual names. By learning what's happening on a Friday, you can do what I do, which is index sector stock, which I talk about all the time. And by index sector stock, right, that's how I look at the world, top down. Whether you look at the world or not like that is entirely up to you. That's how I look at the world. Some people are bottom up and they just say, Meta's going to earn XYZ, therefore I'm going to buy Meta. It's totally fine. Both systems work. Mine's better. But if you sit here and take a look at this, you wouldn't have a care in the world, right? You'd have your little chart breaking out. You'd be really happy and looking at the way things are going, and you'd be fine. And what you could do with this is then you could rank them by relative strength. Not the relative strength that they're giving you, the relative strength that you come up with, the real one, which is what is the market really doing? So what happened this Friday? Well, they sold Google. Okay, so when was there earnings or anything recently? Well, yeah, they had earnings. They had earnings on Wednesday. How'd that go? Well, retail bought because it was, quote, cheap. Well, what did the institutions on Friday that need to be out of the stock do? Oh, they puked it with, both hands. Oh, okay, maybe I shouldn't buy that. And so what this is doing is it's telling you a story. It's the same story that I was explaining to people with, NVIDIA today, and watch this wick. But if I'm to look at NVIDIA on a monthly chart, I'm not feeling warm and fuzzy. I'm not looking at this going, oh, thank God, I've got 17 wicks up here. I'm like, yeah, that's a nasty reversal. And if that was a daily and you were swinging it, you'd be out. So if we look at something like NVIDIA here, and we're the top down, and we're looking at this and going, well, I'm index sector stock. All right, well, index. Okay, do I have a care in the freaking world there? No. I broke out. I have a doji. I had a gravestone here. They undercut that for liquidity, and we're going sideways. Do I really need to be worried about the index here? Not if I'm a long-term investor. Not a care in the world. Right? And then you would start again. Well, how about the stocks? Do I need to care? I don't know that I have to care long term because I'm still in my major uptrend. But I have to look at this and go, well, I've got this wonky thing. I tried to break out. I failed. They took me over. They failed. They can't close above this level right here. So does that make me feel, I'll drop this line and say it with me. Oh, it would have been cooler if that would work that way. Sure would be cool if you do. But if you see that right there, I would look at that and go, well, I really can't get over that reversal bar. So, all right, so I'm in an uptrend, but that's still kind of a neutral look. Let's see what happens here. Again, 34,000 feet. We're monthly looking right now, right? This is the beauty of monthly charts, index sector stock. And then you'd come here and go, well, do I need to look at this? What do I want to do with NVIDIA? Well, if we looked at NVIDIA here, the first thing that we would take is, okay, well, I broke out like I was going to rip. And then you completely matumboed and flim-flammed me into, existence, like just utter devastation. But at the same time, and we'll just drop it right there, and we can look at the top of that breakout going, well, that's a major level. Now, if we want to mark it off perfectly, just put it here, and then we just drop. And hopefully you can see where I'm going with this video. And then we look at that and go, well, we never really closed below that, and let's just make sure that's perfect, because we're going to want it perfect. 1582, you guys might want to remember that level, right? I don't have a monthly close below that. Okay, this is a piercing pattern on a monthly chart. Is this something I need to get out of or in? I have my own belief on it. When you look at the weekly and the undercut, it looks fantastic right now, right? Maybe it holds, maybe it doesn't. It all comes down to really this doji when you really look at it, and that doji there and these tests. Is it great? Not really, no, because when you look at it from a swing trading perspective, you would sit here and just look at the basics and go, okay, well, the 55 is pointing down, the 22 is pointing down, and I'm finally back over the 12. And we all know that this wick wasn't there today. It was just a bad print. So what is this telling us? Well, if I'm looking super long-term in the video, I'm fine. If I'm trying to day trade it, I'm not fine. Right? You've had issues the past week or two, and you're holding this level. Now you overlay this and you come here and you drop this and you drop the 200 in, and you're going to have to drop comments on this to see if you're following the vein on thought and how you're supposed to view the world, but to see who you are when you're looking at these charts, because you'll notice that we're in already, and all I'm doing is just showing you technical, and I'm showing you the same names over and over and over again, and I'm showing you different time periods, and we're not looking at any indicators. All we're doing is looking at price and some lagging indicators to see what's going on so far. And what is this telling us? Well, we finally got over the 200. Are we going to stay over? Maybe. Or maybe we're going to hit this resistance like a ton of bricks next week. We don't know. But if we're looking out weekly, you have a level there that hit the 55 week, formed a bullish engulfing this week, and looks like it might gap fill. So if I'm an investor and I'm a longer term investor, do I feel better with this than I did a week ago? Yeah, I do. Right? So it comes to how you're going to frame what it is that you're looking at. So then when we start to look at stuff like gold, and let's get rid of everything again, just go back to price, and we'll just go back to starting the monthly, and we start seeing that gold has a new monthly high close after it just broke out here. Well, that's telling us another story, okay? And so now we're learning, right? All this data, it's all feeding down and going, okay, if I was buying gold since Jan 1st, every week is up. Well, what the heck's up with that? Well, to me, this is uncertainty with what's going on in the U.S. and the current administration and how quickly and fast-paced things are going. If I looked at this on a daily chart, it's a completely different issue. It's the same thing, whether it's gold or the 10-year, and we look at the 10-year here and go, okay, on the daily, we're trying to get back through the 450, and then we'd look at the weekly and go, well, we didn't go anywhere. Then we'd go and look at the monthly, which is really where we would start. And let's just drop this down so you can see. You're making lower what? Lower highs, and you're making lower lows. Does that mean that we're going to break down on the monthly, or is that going to flag? We don't have a clue, but we would note that lately you're unable to get through these other levels and you're starting to have a problem. So even when we look at the daily, we would look at this and say, yep, you might have put in a top here on this. And then we would just very simply drop a level here. And I'm going to show you why you care about that. Okay, I'll give you two great examples of this that really come to mind. If we looked at Meta as we just went over, and you bought Meta on earnings, right? So you bought the day of earnings and you paid $6.96. At the end of the week, or after earnings rather, where are you? You're up. You've made money. Now, could you have bought better? Are there better spots to buy? Sure, whatever. But from earnings, have you made money? Yes. Okay, let's go take a look at Reddit. You can see where I'm going with this, hopefully. Now, you haven't come out with earnings yet, but you broke out in here, hitting the highs, you retested an area, and now you're hitting highs again. Have you made money? Yes. You're going to look at this and say, well, what does this have to do with anything? If you're looking at them this way, you've made money. If you're swing trading these, right? Because you would just go, oh, I'm going to swing trade them. And based upon that, wake me if it gets to the 12 or the 22, and then maybe I'll figure out what I'm going to do with it. And so what this is doing is it's allowing you to understand what you're supposed to look at, because you're going to go back to that barbell that you're going to have ingratiated in your head, and you're going to say, this is what I'm supposed to focus on. Or you're going to be this guy. And this is what you have to decide. And you can already see it. We're going to talk about patterns right now. Opens up, comes down by when? An hour and a half later. Opens up, comes down by when? Hour and a half later. I mean, over and over again. If you have not seen Bill Murray's Groundhog Day, you're staring at the movie. I just saved you 2 hours. So what you want to do here is understand that this is what's happening over and over and over again, right? So if you're willing to go through this, cool. Great. Size accordingly, swing it. If you're not willing to go through this, you have to understand that this is the new reality, that tech stocks now have actual volatility that people aren't used to, and everybody's not getting this. Everyone thinks that these names were all supposed to be flatlining. The reason that people didn't put their entire net worth into tech stocks is because of the volatility. People that have been trading like 5 years don't get this, because you had Itchy buying $1.7 trillion worth of everything that moved down, that he had you convinced that JPEGs were NFTs. So when you start to look at this stuff, you don't understand that, like, oh no, 20 points on a $700 stock, and then it's going to come up in 2 days and hit a new high, and you're going to get annoyed because this is where you sold because it undercut the low of the day, right? Like how many comments am I going to get on that from it happening to people? Like, it's happening all the time. Or, Trump sneezes and then all of a sudden someone thought he said he hated Meta, and so the stock drops 20 points. So what you have to realize is this is the new normal. This is just normal with what you had before. And there's two reasons for it, but I'll show you what I think the two major ones are. But when you look at why you're going to have this volatility, you need to understand something about it. It's normal, and you're going to say, well, how do I know that these moves of 5 or 6%, why are they normal, and how do I know that? I'll give you 2 ways that you can tell why they're normal, and then what this does for you. The very first way that you can tell this is normal is just by looking at the VIX, guys, okay? The VIX, it's not moving. Your names are all over the place, right? My names are all over the place if you're trading tech. And so what you should have picked up so far from this is I'm trying to get you to identify which chart you should look at and how much time you should pay attention to them. Because if you're going to start paying attention to 10 or 20 point moves in Meta, and you're going to say that you're a swing trader, you might as well just get stopped out and ready to check to St. Jude. You might as well not even buy the stock, because it's just going to happen, right? You're going to have to change your thesis. Now, to reiterate, this video is a little different. What I'm doing is I'm showing you processes that I have used over 2 decades of doing this that hopefully will keep you out of harm's way. See, if you don't know where you're going, you're never going to know if you're there, right? So like if you're day trading something and you're saying, oh, I'm trying to stay in it for a week, well, that's not going to work. There's a way to do it. I'm going to get into it. But I want to reiterate again, the VIX isn't even at 20, guys. So when you're looking at guys in the general sense, because 15% of these videos are watched by women, just understand that. Like, it's not like this is unusual. What's unusual is the speed in which the current administration is changing policy. That's what's unusual, and we're not used to it. And that's not good or bad, it just is. And there's ways that you can understand what's going on. I'm going to give you examples now. So for example, it's not the VIX. So you can't say, oh, it's this volatility, it's going to calm down. No, this is the new normal, or as I refer to it, normal, and I'm going to show you why it is this way. But one of the key things you can do is, like, let's take Meta, for example. What I'll do is I'll change the color of this. Granted, I'm going to leave the standard methodologies in that they have in. But what I want you to do here is just understand something. So if I was to look at Meta here, from November 6th on, you have the ATR. Now, ATR is average true range. Average true range is the range that something is going to stay in for a period of time, okay? For that period, usually if you have it on the chart, 1 day. So there's a 67% chance you're going to stay in that range, which means if you took the ATR and you just took this day and you went, 7 up to here, wherever 7 is, and then 7 down to there, that would be your range, or 14 up or 13 up. That's the 67% chance of that happening. If you take from here over, and it doesn't matter where, even up to here, okay, and you overlay that with where you are now, this is the difference, and this is what you have to wrap your head around. Here's 14, and then you're here, and it's a 42% increase. So, and hopefully you can see that, but I'll pull this up so that you get it. So you have a 42% increase in the average range of that name. And at the same time, how much has the stock gone up during that period of time? And you'd go here and go, oh, it's up 15%. So the volatility of the name, and if you're in the community, you already know this. We talked about the historical volatility versus the index. Is like a 3x, meaning the volatility that's in these names right now is far outpacing what you've been dealing with. So I'm going to just say that again so you get it. The volatility that is happening in these names is far outpacing anything that you've ever had to deal with. Now, there have been times, and I just want to show you this so you get it. There have been times where you've had spikes on news and that the ATR will kick up, which means that the volatility is going to be greater. You can overlay Bollinger Bands with it and see how the Bollinger Bands expand or widen. That's not what you're dealing with here. What you're dealing with here is that the volatility in general for months is creeping higher. So when you're out there trading and you're trading the same exact way you traded here, you're just getting stopped out left and right, and you don't understand why. Okay, so this is what it boils down to. You have to look at your positions and say, I want to swing trade this. Goes back to the barbell. I want to swing trade. I want a long-term trade. And then set your stops and targets according to what the ATR is. There's a whole book on this. Richard Dennis made it famous. It was called The Way of the Turtle. And the whole premise is that your stops should be predicated upon the volatility. So like if you're looking at this, for example, and you're setting your stop the same way here that you're setting it here, you're just going to get stopped out left and right. It's not going to work the same way. Okay, so what your goal here is to increase your win rate and stay in names. So when this is happening, you have to understand the volatility of that name. Now, to put this in context, when you look at something like a Meta, watch when you look at the S&P. And what I'll do here is I will widen this out and just clean this up so that you can see it. And you would say, well, from November to here, we were at a 63, and then you would just go, okay. And it doesn't matter what tech name you said. I'm not going to go through all of them, but you have a 17% increase in the S&P. And you can see that Meta, when we went through it, had a 42. So right now, historically, what you're seeing is the volatility increase on names. Just stay with me with this. The volatility increase in actual stock names is actually at 45. And again, we went over this last week. If you're in the community, remember this in the week ahead video. Why I'm saying this is that is 45 now, right? When I marked it on average, it's 45 for tech names. And then the S&P's at a 15% increase in volatility. So you have a 30 vol discrepancy between tech names and the index moves. And people can't figure out for the life of them why these things are trading like penny stocks. Now, you might want to re-listen to that part, and I know it's a little advanced, and that's about as clear as I can make it. But bottom line is, the movement that you're going to see in the S&P or even in the NASDAQ is not going to be reflective in the names that you're going to see in the stocks. Now, I want to say it again, because the whole thing that we're leading up to is why we started this video, and now where we're going with it is for you to understand why this is happening so that you can profit from it. Meaning if you're a day trader, you should understand that you're going to get those pullbacks that you're getting, right? We're doing a lot more of those kinds of trades right now for obvious reasons. But you might say, well, that's the S&P, show me the NASDAQ. And then I'm just going to take the 6th again and come up to there. And you're going to see very clearly that that's roughly 19%. And I'm being very generous with that. And you can see that right here. What that's going to do for you is understand that's where you're at. You might say, oh, well, that's Meta. Meta's crazy. Okay, let's take the single greatest name on market cap that's out there right now, which is Apple, and go see what Apple's been doing since the 6th. And you're going to see that you're at a 50% increase in volatility from November 6th to here, based upon the ATR, meaning before we would move $4 and roughly we're in the same area. Now we're moving 6. And people don't understand why they're getting whacked around or why the options are more expensive, even though the VIX hasn't moved. They don't understand that the historical implied volatility are completely out of whack. And that's why I walked you through. And how to calculate this, and the easy way to do this, is look at the ATR of the index and then look at the ATR of the large individual names. And it's going to show you that the vol is completely off. This is the issue that you people are dealing with, and they don't understand it. You should understand it now. If you don't, you're going to want to watch this part of the video again. And it's a very important concept, because if you are one of these guys that's out there and you want to own Reddit, right? Reddit forever, yay. And so you're out there and you want to hold it. Understand that for this thing to move 11, 12 bucks, it's just a normal Tuesday, all right? Where before, if you were trading it in October, and yeah, the stock did explode. So this is an awful example, but you get it. If the stock explodes, yeah, this is what's going to happen. But now you're going to get those kinds of momentum. But also, this move is not commensurate with what happened here. So when you look for this stuff, just understand that and understand which way you're going to be. And then I'm going to show you the other side of this and why you're seeing the volatility that you are. Now, when all you young whippersnappers started trading, you didn't have margin interest. And margin interest is tied to Fed funds. This is why names like Hood are going up, IBKR are going up, and Fed funds, and let's just make this a little brighter for you guys out there. You guys like your bright colors, right? I guess from all the raves you go to. Who knows what you guys do on the weekends. Anyway, here you go. So you can see right here that Fed funds, this is what a bank is paying between banks, right? Effective Fed funds, or borrowing from the Fed, rather. I say it that way before someone says that's the international bank rate, whatever. But you get where I'm going with this. Jen, right? Great financial crisis, 0. Itchy tried to raise rates. Everyone revolted. He panicked. And then we had what? The pandemic. Then we were buying stocks along with Itchy. And then he said, I can't do it anymore, guys. I'm tapping out. And then all of a sudden, bam. Right? Greatest rate hike in history. This is why you're paying like margin interest now. And people are like, what's this line item that's coming in? And you're probably used to it by now. But when you see this, all of a sudden, if you're in a name and that name's not working out, not only are you losing money, but to add to that suck salad, you're also paying on margin to lose money. Well, all of a sudden, that is going to increase the volatility. And I'll do this and say it again. That's going to increase the volatility. And what that's going to do is that's going to make you want to get out of those names faster and into those names faster, which is going to increase the volatility. Hence, that's feeding one of the reasons why the ATR and the options are doing what it was doing. It's also one of the reasons why it's making options a heck of a lot harder to stay in longer term right now, which most of you are probably noticing. Hey, it's really hard to stay in these options long term right now. Like I can catch the move and then all of a sudden it switches. Now take a look at this. When we want to understand how all this is happening, let's just look at New York Stock Exchange margin debt, because it's going to tell us exactly why this is happening. This is directly from the New York Stock Exchange. This graph was done by Sentiment Trader, and I went all the way back to the Great Financial Crisis. And I just want to show you what you're looking at. all you're looking at is an aggregate amount of, if they're totaling it up, where you're at. And you can see right here, they're saying, here's the S&P, and here they're saying, oh, you're almost back to those levels. Yes and no. You have to look at it from an aggregate standpoint, but you really want to look at it on a percentage basis. What I'm pointing out is, as we've been going up, people have been adding on margin. So as the stock market's going up, people are adding on margin, okay? So they're adding on margin as the stock market's going up. As it's going higher, they're increasing the amount that they're putting on. As the market's going higher, they're increasing the amount that's going on. So it's not like the market's going higher and they're putting less on, right? They're putting more on aggregately as it goes up. So that's going to create, say it with me, more volatility. But wait, there's more. This is really important to get. You see where you're at here? This is New York Stock Exchange margin debt on a percentage of market cap. Meaning if you took all the market cap of all the New York Stock Exchange names, and they use the S&P here instead of the New York Stock Exchange. And we look at this and we go back 10 years, what do you notice? You're at lows. So the amount of money that's out there that could still get put into the market to even get even with where you were on an average basis on a percentage of market cap, you're not even close. So what I'm getting at here is you have massive volatility as this is increasing, and the margin interest hasn't even really kicked into an average level over the past 10 years. Where am I going with this? Where I'm going with this is to tell you that the volatility is probably going to get worse. It's not going to get better. Because as this starts to kick up, you're not even levering where you were before. In other words, based upon the market cap of the New York Stock Exchange in 2020, for example, you were here as a percentage of market cap. In 2016 and 17, you were actually higher as a percentage of market cap. You're nowhere near any level on average on what people that had an account and what they would lever. So this can go a lot higher, a lot higher. So the aggregate can go a lot higher. We're not even close to where we are here on the aggregate side. And also on a percentage of market cap, it can go substantially higher. Now, if the market comes down, this may actually spike if the market came down on a percentage of market cap, because then the market cap's lower. So let's just say the market crashes. Then all of a sudden, this might spike even if it stays stagnant because it's a percentage of market cap. So that's why you always want to look at not only the percentage of market cap, not only the aggregate, but you want to look at the growth as well. Now, when you look at the growth, the important thing about this is just understand, and we're going to take a look at how to calculate this in a second, or what it's really representing. This is margin debit percentage of growth, and what they do is they take a data point from 12 months to 12 months, and really what it tells you is as the debt is growing, how fast is it growing? Right, from data point to data point. And what they're trying to do is they're trying to keep you in this line of net, the 0 line to 20. When I look at this, it's really under the 0 line or under this 20 line. So in other words, to me, when I look at this, you have a plus 20, you should have a minus 20 line like right around here. And that's actually drawn kind of high, but you get it. So what you're looking at here is you're like, okay, well, we crossed here, and then when we crossed here, then we started lifting again. Right, because people felt warm and fuzzy, started putting money in the market, and this ties right into when Itchy decided to do what? Say, hey, we're not going to raise rates anymore, right? So this tells you and ties you into what? Again, as we look at all the technicals, it ties you right in back into the stool, right? We're not going to raise rates anymore. There's the macro, what names are going to be affected by that, and then what are the technicals telling us, and that gets us the stool. So a little bit better before that fades. No, it's fading too fast for me, so I'll put that back. Oh boy, it's gonna be like a little contest now, isn't it? There it is, boom. So all of a sudden, now what happens, right? So you have to always look at the macro, okay. But at the same time, you see how that turned right there, and then it lifted from there? Now look at where you're at. And you're saying, oh, well, we could get here. And there's so much on a percentage basis where this could still go higher, right? And we get that. That is disgusting. Better. I actually think I made that worse. Let's draw that better. Let's just stay with me. So now what can happen here is this can get a lot stronger. So let's take a look at how this is calculated real quick. So again, I don't have time to edit these. I think they're better off raw, because then I may edit something out that just clicks with somebody. It just seems to work doing them this way. 12-month rate change percent margin debt among U.S. investors, okay? That's what it is. 12-month rate of change, data point to data point to data point from 12 months out, over and over, connected, up or down. That's what it's doing. All right. Now let's compare this with .com, and let's compare this with the Great Financial Crisis. Now, out of all the slides, the reason why this one makes the most sense to look at that way, from my perspective, and I can look at any of these that you want me to, just comment below and I'll do whatever one you want to do. I'll tell you why I think it makes the most sense. Because what we're getting is the growth. In other words, you want to look at the growth. You want to see, are we growing too fast? Meaning, are we getting frenzied, in other words? So if I was to go here and say, well, I don't know that we're getting frenzied, but you'd look here and say, well, you have here and then here and here, and then you're like, oh, well, it's just like .com, because the percentage of growth right now was 3x here to get into margin than it is here. Not only the market cap is so depressed, but the percentage and way that you grew when you had these peaks, you're not near that peak level. Now, what's fascinating to me about this is if I ever wanted to have a signal that we're at a top, if you go back and say when New York Stock Exchange margin debt as a percentage of growth hits this 75 level or 70 level, I might want to start paying attention. It called the .com, it called the Great Financial Crisis. It didn't call this because we were really fighting with Itchy, so we had to wait for Itchy to run out of money. And then when that happened, it faded. That's why it's so hard to use this data in here for anything of value because of him. So I tend to avoid it, but I do think that when you see this, and I don't think the Fed will ever do that again in my lifetime, but who knows? I should never say never. So when you're looking for these areas, then what you would do is just go, okay, well, are we here? No, we're here. Okay. Are we here? No. And are we here? No. What is this telling us? To say that we're at a level of margin debt that is relation to the .com or Great Financial Crisis or tip of the pandemic is not even close. You're 3x off of that. So that means that you have a lot more room to go. And what this all means, before we get into some names now that we should be looking at for next week, what all this means is that the volatility that you're experiencing can get a lot more. And that's a good thing if you know what side of the barbell you're on. Now, before we go further, I want to just reiterate everything so we're all on the same page. What we're trying to discuss here is what kind of trading you're doing. And I really think when you look at the volatility, people need to make this decision. And I don't think they're making it. And this is why we're spending so much time on it. So when we look at things and we have the stool, and I could drop a line in here, but we could just see like a picture of a stool like before, but I'm going to go old school here. I'm going to draw you one. You're welcome. And when you see that, you're going to know, well, that means the macro leg on what's going on in the market. This means we don't know what the Trump administration is going to do or what the Trump administration is going to say. The one thing we do know is it's going to affect us. Good or bad, it's going to affect us. Then you have the fundamentals of what happens here from the macro, and that's going to affect the earnings. And that's really what you should care about. The earnings, the gross margins, the revenue streams, etc., based upon the actions of whatever the administration does or whatever some other administration does globally, or whatever the Fed does affects the fundamentals. Then you have the technicals, and that's going to tell us when we should enter, when we should get in, etc., etc. So once you have this done, you now know what the heck is going on, who's affected by it, and then when should you get in or out of the trade. And that gives us our little stool. At the same time, what people need to pay attention to, and again, this is a reiteration, but I think it's very important before we go forward, when you see this, and I say barbell, what I'm referring to is whatever your barbell is. So for some, day trade could be a scalp, meaning I'm just going to scalp the trade, and then we'll clone this because we want them to be perfect, don't we? And so then, oh boy, we're getting nuts there. Hold on, stay with me. And so then what we want to do is we're just going to put that over there, and then we're going to have to drop this down, and looks like my promise is broken, and that is not perfect, but I think we got there. So whether or not that is going to be a scalp trade or a day trade, for example, there are times where I will just leave day trades on for the day and then take them off. If they're going in the way that they're supposed to go, I'll just leave them on. Just use a trailing stop on it, and as long as it doesn't break, there's nothing for me to do. A swing trade could be 1 week. To some people, it's 2 to 3 months. So you need to understand what it means for you. What this means for me and the variations of a day trade could be very different for me than they are for you. And they could be very here. Wow, more coffee today for sure. Let's see what time I'm filming this. It's right down here. So we're definitely going to need more coffee. But if you can see how this is going, that's up to you to decide. It's not up for me to decide that you should be, just using VWAP and scalping. You have to understand that it's up to you and what you want to do and what fits into your time frame. And I'm not going to turn this into a whole educational class, but this is a really important concept to get because people are like, oh well, Bobby or Freddie Fingers just scalps and he's rented a Lamborghini for the day. All right, cool. Then go be like Freddie Fingers. Or you could actually analyze your trades and go, you know what, my trades, if I'm in for 15, 20 minutes, I'm killing it. And then I better get out of the way because then I do something silly or something happens. Okay, well maybe you should do what's working for you and not what's working for Freddy Fingers. The same over here. So whenever I show you trades, as I'm about to, you have to see and look and go, does this fit into my criteria? Is this something that I want to do? And is this something that I'm capable of understanding? Once you've gotten that out of the way, it makes a big difference. And let me explain. So here's Lily. Now, Lily is going to be one of the names that I'm going to suggest that you look at on the week ahead. And when we look at Lily, it's perfect for this, and I'll explain why. First and foremost, with something like a Lily, here's your W, it's perfect. You're breaking out, and then you pushed, and they just came out, by the way, and said, oh yeah, we're going to just absolutely crush, and then it lifts and pushes. Now, what do you see happening here is this move breaking out, and then you have a little bit of follow through on Friday. We have a doji sitting perfectly above after a higher high, and you have the potential of a gap fill up here. So someone like myself is looking at this going, I don't want to swing trade this under a major resistance, but there's money to be made here off that news because their earnings were fantastic and they raised guidance. A swing trader is going to look at this and go, oh, the 12, the 22, the 55, they're foaming at the mouth. They might pop in the 200 and be like, oh my God, this is the best day ever of my life, right? Like they're going crazy. They have the volume, everything. Someone like myself is looking at it and going, you know what, there's some quick money to be made here. I don't know what's going to happen with RFK, and Trump. I don't know what's going to happen. Do I really want to stay in this thing? So what I'm doing is looking at the movements, watching this, and then seeing how quick I can make money and then just get the heck out of the way after knowing where my level is. Here, watch this live. This makes perfect sense to me. I might get involved in this. I'm really surprised that this is not ripping everyone's head off. Yeah, there it goes. That does make sense to me. I bought Lily here. See what you do. It's a good sign. Oh, well, $3 already. Trimmed. G-subs fest. All right, trim some. I'm not going to get out of it anymore. I'd like to leave it on, see what it does. Maybe if I get a lower low, then maybe I'll sell more of it. But I don't see a sense to do anything there. That Lily trade, it just makes so much sense. I don't understand why it was even down. I think they were just playing possum, candidly. Up $10, trimmed. I don't know that I'm going to hold and go for a ride here. I'm probably going to take it when I start to see it. Where are you at now? 62. Okay. Trimmed. Let's just mark this off so I don't sit here and stare at it all day. I'm just going to put an alert there. And as soon as that goes off, I'm just going to close the rest of this. Boop. Out of the rest. 100% out of Lily. Thank you very much. So now you can see the difference where someone like myself is saying, I'm just going to scalp this. You might be looking at it and saying, no, they're going to absolutely crush. I'm willing to stay in it. And then based upon that, you're going to say, I'm willing to ride this. Now, once you say you're willing to ride this, after you just took in the rest of this video, if you're not looking at what that means to you and you're not looking at something like the ATR and going, well, that means that on any given day, based upon the ATR, I could move $23. If you're not thinking like that, then you've already lost. That's the whole point of showing how all this stuff's connected. And of course, this stuff's going to change with time, but that's up to you to understand that. Like, here's another example on the other side of the barbell. And this is how I think you need to look at it. For something like a Lulu, and I'll show you this real quick so you can see the actual trade. This is a spreadsheet I keep. I'm going to show part of it because it's in the community. But like these are names that we bought and we've been in for months. So Lulu, we've been in since October, and you can just see the others, right? It's not all of them. I just took a quick snapshot to show you. So this we bought at 286. It's closed at 398. Spreadsheet didn't update. Last time was 411. So we're up well over 100 points. Now, as this is moving through this level, we see something in here, and then it was earnings, and then we start to get involved because we like the idea and we like the structure of the stock. There was a lot of like really solid reasons for getting involved in here. You could start seeing the turn, the lift through the RSI, the connections, the higher highs. It just started to make a lot of sense, and then we just let it build. We just let the structure change, and then we just got involved. All right. So once we start to see that, we allow the trade to play out, but we understand why we're in it. And this is a really important concept. Once you got it, you got it. So I went over that ad nauseum so that you understand it. Now, going forward this week, you're going to see a lot of people look at names like, take Coin, for example. Reasons for that are they're going to be looking at things for the earnings. And I totally get why you would be looking at this for earnings. I absolutely 100% understand why you would be looking at Coin for earnings. The question really becomes, last earnings, this is what happened to the stock. Last earnings, this is what happened to the stock. And we can go on and on through it. So did we pop last time? We did. The question is, are we going to lift this time or not? Now, that's up to you to take advantage of that. But what you'd have to realize in doing this is just do the same thing when you go look at the ATR. And it's a real simple way to do this. You could actually really want to look at the option spread to determine the volatility. And I'll do that really quickly so that you can see it. But like, you have to understand that this day you're going to move at least 17 points, at least, okay? And so when you're doing those trades, you want to look at it that way. But really what you want to do, and I'll just say it for time's sake, you'd want to take the calls and the puts. Let's clean this off real quick. But you'd want to take the calls and the puts. So here are the 275, which is, I believe, where it closed. And that's roughly the last trade. We're going to call that $14, all right? And then the next one right here is going to be the puts. And you can see that they're at $14. So 14 and 14, what you do is you just times those together and you're going to get 28, all right? So by looking at that, then you would just take those options and say on that day, the option market is pricing in roughly a 10% move that you're going to be up 27 or down 27 is the range. So you have to understand that when you're going into the trade. But I do think that this is one of the names that you should most certainly be looking at next week. It's going to be pretty wild. Earnings, to me, when we look at this, they haven't been great. So I'm not really sure why everyone's getting overly excited about it. That's just how I feel about it. The other thing I really want to hammer home here is looking at Tesla. This looks disgusting, and it should have held on Friday. Actually, Friday at the close, right near the close, I tried to play the bounce. And it just was like completely rejected, just pretty much like when I tried to pursue Giselle, but like it just didn't work out for me. We could not hold that 372. Watch this on the 5-minute watch right here. And you can just see this 364 or 363 level that's down here, and we just couldn't hold it. What I'll do is I'll drop the line from here, and then we'll just expand the time frame out, and you'll see it, where you're trying to hold in here. And then I'm like, oh, it'll hold this area. It should hold in here. This is usually where we bounce and everybody thinks it's going to go higher. And bad news with obviously what they have right now, which is a lot of bad news, it just actually got worse. So breaking down from here, this can get a lot worse, right? I think your next level is like 348. So this is definitely one that has seen better days. And now you're starting to break down structurally. So we actually have the tests, the rallies, the tests, the rallies. And obviously, it was like a yay Elon love fest that day, where he's going to create a robot that turns into a blender and also turns into a car, kind of like Transformers, and we're all going to have one. So now, that people are like, well, are we really going to have a blender that's a robot that also turns into a car? Like, geez, maybe not. And so it seems like we're starting to see that way, and sales are not going really well. So now you're down to about this 346. Also, he's gotten way too political for a guy that owns a company. So you're basically taking half the country, and turning it against you. So I don't really understand as a marketing strategy, but he's the richest guy in the world, not me. So I would watch this level pretty carefully, and we'll go from there. But this seems like you have a weight on your shoulders here, doesn't it? And now I'm getting these death crosses, and they're not perfect death crosses. I know it's not the 200 crossing the 55, and I still have a ways to go there. But this does not make me feel warm and fuzzy. So I would keep my eye on this next week. Now, if you're in the community, you already know this, but I'm going to just say it so that people can get it. You need to really pay attention to what happened with the big guys on the conference calls. The Microsofts absolutely blew up. They're not increasing their CapEx. They've realized that they've lost this race. That's where my head is with them. I know people are going to disagree with me on this, and you're welcome to disagree with me. But I don't see how I'm wrong here, where you have this support level and you've clearly broken it, right? I mean, that's clearly broken its support level that's in here. Earnings and that conference call was a dumpster fire. As somebody that was long into it, believe me, it was a dumpster fire. If you take a look at Google here and how this is breaking out, you can see it very, very clearly that you are breaking down, and you're probably looking at this 177 gap fill if you don't hold this level in here. So I'm trying to show you what's happening. What is happening more than anything, even if you look at Amazon, which to me, I don't really understand the lack of love here because the growth was there. They just don't have the product. Amazon to me would be more neutral than what happened to Google and Microsoft, which are clearly falling behind, and they're all falling behind Meta. And if you don't believe that, you need to go back and listen to this conference call. It is very clear to me that Meta won on earnings, and Meta's winning this AI race. And we can get into that in next week's video. That's it.